My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Jack Schwager, who I'm sure many of you have probably read his phenomenal interviews, the series of Market Wizards that he put out over the last several years. Jack, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in interested in markets? And how in the world did you even get started putting these books together?
Okay, well, there's a lot of questions for a first question. I got started in the industry by accident, actually. I had a master's in economics out of Brown, and I was just looking for a job, and I fell into a research analyst job as a commodity analyst at the time. This is back in the early 70s. That's how I got in the industry. I got into writing actually through my job. There was originally a commodities magazine, which was going through different ownerships and names, but I was writing for them initially, and that was my first publication of any sort outside of writing for the firm. In my first book, I took a sabbatical after I'd been a director of research for about a dozen years. I took a sabbatical because I didn't think there was a good analytical book on the markets, on the futures markets. I wrote a book called A Complete Guide to the Futures Markets. That was in '84, which was about a dozen years, I say, after I started in the business. And that led 5 years later to my writing the first of the Market Wizards books. And that came about because being in industry, actually my first job, the position I took, the very first position I took as an analyst, I was replacing a fellow called Michael Marcus, who would be unknown to the world were it not for Market Wizards. He's a very private individual, but he was my first chapter in the first Market Wizards book. So I met him actually by chance. And through him, when he became a professional trader managing money for Commodities Corp, he was the one who hired Bruce Kovner. And so I knew Bruce through Michael. And, those connections also led to other connections. And that basically led to my first Market Wizards book. So in short, an answer to multiple questions.
So I shared at the top of the Twitter space. I'm smiling as I looked it up. The Market Wizards book, and on Amazon it says when you did a purchase. So I myself bought that book October 18 of 2003. I was still in college, right? And I still have it actually on my bookshelf, and I've read the subsequent books since. I'm curious. Back then, it must have been harder, I can imagine, to try to reach out to these in quotes legendary traders and investors, and basically pitch them on the idea of I want you to be in this book that I'm putting together. What was that process like back then? I mean, nowadays you can find anybody from LinkedIn or from any of these other social network sites, but back then it wasn't as easy.
Yeah, you're right. I mean, we didn't have internet. Back then it was just the early days of PCs. So well, like I said, I knew Michael personally, and I also worked through him for a year as a researcher for him, remotely for Commodities Corp. So I knew people there. But like I say, so he and Kovner came directly through that. I forget how some other people I knew just through word of mouth, like Paul Tudor Jones, who at that time, I mean, this was, he had formed his firm, but he'd only been business as a trader for about 5 years. So he wasn't as famous as, was nowhere near as famous as he is now. Some other people, I don't even remember, like people like Marty Schwartz. I think, again, I found through word of mouth. I'm not sure how I found him. So somebody, a lot of it was really networking through word of mouth or personal acquaintances. As I said, there was no internet to research this stuff on.
Let's talk about some of the similarities and differences among the different traders that you've interviewed. It's my sense that a lot of the sort of real great traders over time tend to, kind of have mediocre returns for a good amount of time and then have a couple of fat pitches where they really kind of have, outsized returns that make up years of maybe relative weakness. Am I off on that idea that the great traders tend to have lumpy performance?
No, not necessarily. So yes and no. I mean, some cases yes, some cases no. If the returns are very lumpy, I would end up not interviewing because I'm looking basically either for the great story where somebody turns, a small amount of money into tens or hundreds of millions of dollars, or I'm looking for somebody who has just a long track record of great return to risk, which by definition is the antonym of lumpy returns. So, but there are people certainly in the books which have had that type of experience, especially if you count the early years that you mentioned about getting off to a poor start or whatever. That is actually, that was true of quite a number of traders. Or if they didn't get off to a poor start, they had episodes where they had one or in some cases multiple really bad trades, which did a lot of damage. So that part's not unusual. But for the most part, the returns, at least at the point where I interview them, tend to, because who knows what happens in the future. Sometimes they continue, but often it's impossible to continue with returns as consistent and as enormous as when I interviewed them, because you do have regression to the mean coming in. So if you take somebody like I'll take Bruce Governor as an example. I interviewed him. He had been trading for about 10 years at that time, and his average return, I still remember. I might not remember exactly. I think it was something like 88% a year. Now, as good as he is, he's not. I know he's not going to continue doing 88% a year. I mean, just can't be done forever. But he still continued to do quite, very well. I mean, Caxton went on to be a very successful firm and managed tens of billions of dollars. So, yeah. Anyway, so it's kind of varied. It's varied, but for the most part, certainly when I'm interviewing, the returns are anything but lumpy.
Would you say that there's a consistency in terms of, let's call it, quirkiness among some of these personalities? I remember, I forget who it was, but I'm pretty sure, if my memory serves me right, there was someone that you had interviewed who made it a point that he either is in a room with no windows, so there's no outside stimulus, and trades in his underwear, right, or something along those lines, or trades someone naked because he doesn't want to sort of have the effect of anything throwing him off with the trading day. Are there elements of personality that make the greats, from your perspective, just odd, for lack of a way of saying it?
I mean, a lot of them you might consider odd, quirky. They're certainly tend to be obsessive, which is one type of odd, and some of them are very reclusive and shy. I don't know if that's odd or not. I don't know how much odder they are than a cross section of people. So, but you do get characters that are you might describe as odd. It's not unusual. I think part of it also may be there's in some ways, I consider a lot of the people I interviewed to have a certain genius when it comes to trading. I mean, in some cases they're geniuses, period. I mean, so I think somebody like a Thorpe is just a genius. Mathematically, he's a genius in trading, just a genius overall. So there are certainly those type of D. Shaw, people like that. So there are certain people who I interviewed who would be geniuses under any category. But I think a much broader number of people are geniuses, not so much at a general level, but have a genius for the markets and trading. And when people have an extreme skill or talent in one area, be it trading or music or almost anything, or math or whatever, that can go with some, with oddness in other aspects. So I don't think that part is unusual.
What about the idea that these kind of great traders tend to be more contrarian in their thinking? So I had Jason Shapiro on one of these Twitter spaces. Very much enjoyed the conversation with him, and he and I actually, I think, largely think similarly from a macro perspective. But is it fair to say that it kind of goes back to that fat pitch argument, that a lot of these great traders tend to just think differently and are so viscerally independent in their thinking that they don't necessarily get caught up in FOMO?
Yes, I mean, you have to be different because the majority is going to lose, right? So by definition, if you're going to be successful, let alone very successful, you have to be doing something that's different. That's almost a given. The contrarian aspect is a little bit, is not exactly that. Contrarian is its own particular style, and Jason, is the epitome of that type of trading. And he's not the only trader. There are other traders, like one I can think of off the top of my head, Jimmy Baladimas in Hedge Fund Market Wizards was an extreme contrarian. There have been others, but I think that is not the denominator across traders. It occurs in some traders. Now, they're all different from the crowd, so to speak, by definition, but to the point of specifically looking to get into markets based upon always going at the time you're getting in, being against the general wave. That is a particular style of trading that is true for some people, like Shapiro and Baladimas, but it's not true of the broad range of traders. And in some cases, some of the traders tend to be, much more, in a way, trying to catch the trend, but catch it earlier and get out before it became too popular.
As you've interviewed these different traders over the years and put these books together, what did you yourself take away that you use for your own trading and investing style? I mean, I got to imagine there were things that were almost like aha moments as an interviewer, and there were probably things that you would even question if you want to push back aggressively around a way of thinking from whoever you're interviewing.
Yeah, so definitely the influence. I mean, I would say probably the most dominant influence. You get hammered on the head with understanding that risk management is absolutely essential, and and in particular, to as the epitome of that, and to kind of crystallize it, I think of one thing that Bruce Governor said, which I think of mentally many times, all the time. Anytime I put on a trade, in fact, and Bruce said at one point in the interview, I always know I'm getting out before I get in. And that is just terrific advice, because it lets you define how much you're going to lose on a particular trade. Except if the market gaps, of course. But generally speaking, it defines your maximum risk, and it also allows you to make that decision when you're completely objective. Because when you're not in the trade, you can think objectively. Once you're in the trade, you've lost that. You're no longer objective by definition. So that's one piece of advice. Anytime I put on a trade, if I put on a trade, at the same time I'm putting in a stop on the trade. When I'm putting in that stop, either explicitly or not, I'm thinking of that. Know where you get out before you get in. So that's something that dictates anything I do. And I should differentiate. I'm talking about trading. There may be positions that I may put on just for long term, and where that I don't do that. For example, I know a couple of years ago I thought I should have some long position in gold. So I've got some long position in gold and gold mining stocks, and I don't have stops on them. I'm just in it, So because I figured part of my investment, part of it should be in gold. So that's not a trade. So in that case, I don't have a stop. But anything that is a trade, at the time I put it in, I have a stop. And so that's one strong influence that came out, my own experience of my own books. Then there are other more kind of once in a while things that occur. Marty Schwartz at one point in our interview said, if you ever really worried about a position and the market lets you off the hook easily, don't get out. And we can talk more about why that may be true. And that kind of theme came up very, very in a very dramatic episode in an interview with another trader, Bill Lipschitz, but a perfect example of that. But in any case, in my own experience, that actually one time I was in a position, I had shorted, I was looking to, I was not looking, I was getting short the stock, I forget which index, but I was getting short, probably the S&P, I'm not sure. I was getting short one of the indexes as the market rallied to what I thought was going to be the top of a range. And I was about 85% in the position. It was a Friday. Outcomes are an unemployment report that is as negative as it could be for the market. I mean, there was nothing positive about it for the market. And the market, as expected, starts selling off. And I figured, okay, pretty much that's it, And then about midday, it stops selling and starts going up. And by the end of the day, it closes near the high, and it's a Friday. So I'm thinking to myself, I'm dead in the water in this one. And come Sunday night, I'm expecting the market to gap higher, and instead it opens lower. And I swear, I thought of Marty Schwartz's thing: if the market lets you off the hook easily, don't get out. And I didn't get out. So, there are things like that. So there are other things people have said where I think of it, and it leads to, it's an help.
How important is having a volatile backdrop to success when it comes to these market wizards. I mean, I got to assume that volatility is what kind of separates the men and women from the boys and the girls, so to speak.
I don't, for some, it depends what kind of volatility also. I mean, you can have low volatility environments. There are differences. So yeah, and think about it, right? So for any type of trader, let's say a trend trader, right? The trend trader, you'd think that low volatility would be bad, generally, speaking, and higher volatility would be good. But if the high volatility is a market swinging back and forth in a broad range, in broad ranges, that type of volatility could decimate trend traders through whipsaw entries and exits. On the other hand, whereas volatility, like I say, is normally good for a trend approach, you could have markets where it's going in a direction, but with low volatility. It's not, it's mixed. I don't think, even for a specific approach, you can't universalize and say, high volatility is good and low volatility is bad. You need enough volatility for the market to move, but it's not just the amount of volatility as the directionality that's important.
So I'll take a little bit of a counter argument with you just to play devil's advocate. So I often use this line on Twitter that there are no gurus, only cycles, right? And a lot of that comes from my own frustration, just from a media perspective, in terms of highlighting some fund manager or some hedge fund giant, and they have some great returns. And more often than not, when you actually do the attribution on the returns, it's more because the cycle kind of came their way with whatever theme that they're investing in, what they believe in. Am I off on the idea that people often give too much credit to the individual as opposed to the environment they're operating in at a moment in time? Because it just seems to me that the macro cycle determines the likelihood of people confusing alpha from beta more than not.
Yeah, I agree to a large extent. The old saying is don't confuse genius with a bull market. And so for certain cases, that's certainly true. And in every approach, whatever it is, there are better environments and worse environments. And so there's a great danger in reading too much into returns without considering the environment in which those returns were generated. So, you can get, for example, I mean, lots of examples, but if you take the late 1990s, especially 1999, sort of where we're going up to you had a situation with big internet bubble, and you had lots of worthless stocks going to ridiculous values, and you had very good value stocks actually maybe even going down. And people who had a style like Warren Buffett, for example, or Joel Greenblatt, who's considers Buffett kind of a guy, really a guide to the right way of trading. So Greenblatt, somebody who was a trader who I interviewed. But for those type of traders, that poor environment, they could have done. Not only would they have done much worse than the surrounding people, but they could have even had negative returns where everybody's making money. So certainly the environment can have a lot to do with it. And on the converse, you can have people doing very well just because the environment is very favorable. So you had a lot of, let's say, credit type strategies that would have done very well in the 2000s up to 2008, and then just gotten completely creamed in 2008. They were doing well because the market wasn't just pricing in credit risk, and they were taking lots of credit risk and they were taking credit risk and leveraging it. And so you look like geniuses, but if you looked at what they were doing, it wasn't any genius that they were doing. It was just, you had the market, just favoring people who were willing to take very large credit risk. And the only way they get the really good returns is by leveraging it. So again, that's an example where it's not the trader who's being a genius, it's just being in the right environment, being lucky. And when the tide goes out, so to speak, using Buffett's analogy, then you could see, then you see swimming naked. In this case, the credit traders would have gotten killed because they were taking extreme credit risk, and the markets finally turned against that. So yes, I think there's a large element of that. But really good traders they will do much better in certain environments than others, but they do fine enough to survive and not lose too much and still stay well in the game for over broad periods of time. So you see traders like I think whether it's the last book I interview of traders, unknown market wizards, or prior volumes, a lot of those traders just had fairly the very long periods of time where they did well. I mean, you think of somebody like Druckenmiller who traded 30 years, and I mean, I don't know if maybe he had a losing year here or there. It wouldn't have been very large, but didn't have any massive drawdowns. Managed something like close to 30% a year over 30 years. So that's kind of, yeah. So he might have had years where he had triple digit returns and years where he was zero, but he he did well over the broad period.
Using your terminology around sort of being a genius as a trader, did you find any sort of commonalities across asset class and the likelihood of somebody being more of a genius than not? Maybe some asset class that is less efficient, so these market wizards have a better chance of generating real outsized returns, or is it asset class agnostic?
I don't think asset class is. I mean, asset class is something that determines what a trader does, because every trader, I believe, has a certain affinity for asset class, for duration of trade, through type of trading, whether it's fundamental, technical, or some combination, whatever. But all of those things are ingredients in what type of approach fits for a given trader. But I don't think there's any predetermined, well, this asset class has more opportunity than that asset class. Or there are certain approaches, though, which only lend themselves to certain types of talent. So if you're talking about a quantitative approach, you've got to have quant skills. And so there are certain limitations. But again, that's part of what fits the trader.
Just to reset the room for everybody that's here for the remaining minutes, everybody please make sure you follow Jack Schwager. And if you haven't read his phenomenal books, make sure you do. I got to assume there's always the one that got away, for lack of a way better of saying it. Were there any traders that you really wanted to interview that just for whatever reason the stars didn't align, that you have almost a degree of regret for not being able to?
Yeah, sure. I mean, my first market wizards book, I was very lucky. I believe everybody I asked agreed to do it. So, but in subsequent books, I did have some refusals. But the main one, the one that I always had wanted to do, and I tried multiple times that I never was able to get, was George Soros. And I didn't speak to Soros directly. I never got past his intermediary people, but I never got an agreement from him to do the interview. And he was an interview. That was an interview that I put at the top of my list of people who I did want to interview. One, because he's probably the greatest, or certainly one of the greatest traders of modern times, and also because he had a kind of a very interesting life. And that when I do interviews, I try to get into other aspects of a person besides just the trading. And in his case, you had everything beginning from escaping from Holocaust to when he, in his later adult years, leaving his hedge fund business largely to spend, I don't know how it was, a decade or how long he spent focusing on Eastern Europe and Russia, trying to get those countries to a capitalistic mode of operation and democracy. So he had a lot of things that would have been interesting discussion, plus all his thoughts and philosophies. And so I would say he's the main one who I was not able to get. There were certainly others that I wanted to interview who I couldn't get. So yeah, but that's he's at the top of the list.
Okay, so I'm sure you've seen the same studies that I've seen that would suggest that, at least in the hedge fund space, there was a lot more alpha on average pre-GFC, pre-Great Financial Crisis, than post. And a lot of the reasons seem to be around zero interest rate policy and QE kind of killing off alpha and making it purely about cheap beta. I know you're probably a little bit biased in answering this question, but do you get a sense that it's maybe harder in this environment to identify really truly great traders because there's less alpha opportunity? Or is that maybe the very reason why there's going to be more alpha opportunity and more great traders?
Yeah, no, actually, well, I actually thought that. I wrote my last book about 3 years ago, and just working on it, updating it for the paperback later this year. So I interviewed those traders right before COVID hit, or finished, at that point. And at that time it was over like 2020. So at that point in time, this is now 30 years after I did my first Market Wizards book, and I did think that I would have a harder time finding traders with records anything like in the first Market Wizards book, when the days of the Marcus and Kovners and Paul Tudor Jones, when their heyday, and because I just thought that we had such immense moves in those days, and we had more trending markets, and that I just it would be, and the big thing, of course, was the extraordinary amount of computerization that has occurred subsequent to that first book. You have, I mean, not only we went from an environment where the original traders I interviewed were, while the book was not PC, it was only a few years, after that point. But certainly the point where most of these people are trading was prior to the computer generation, and we went from that to a world of supercomputers, and now, of course, AI. I mean, AI has been around actually for a number of years, but also quant shops with hundreds of PhDs, and multiple quant shops with hundreds of PhDs. I think in this world, you're just not going to find a type of return or return risk that we had in the first Market Wizards book. And extraordinary as it may seem, there are traders in that most recent book that have records that are as good, maybe even the best that I ever encountered. So it may not be easy, but it's seemingly still possible.
Right. I think that's kind of the core of the question, right? It's sort of, have markets become more efficient, and even that has some nuances, right? Because you can argue that markets are maybe more efficient longer term, but I'll take the other side of it. I'd argue that the short term maybe even less efficient, just because you don't have barriers to entry. You've got commission-free trading. You've got a lot of novices, gamblers, for lack of a better way of saying it, that are just going in and out of stocks and trading emotionally. Presumably, that also creates its own opportunity for the real pros.
Yeah, it does. In fact, so and that's it. So I think you hit an important point. So you may have a lot more professional traders, which you certainly do, but you also have a lot more amateurs. And particularly true during that COVID period, where you had all these people, trading, just beginning trading, and the Reddit crowd and all of that. So yes, I believe the participation of amateurs, creates opportunities, even though there may be a lot more professional traders.
Aside from the books, Jack, what else have you been keeping yourself busy with? I mean, I see the Fund Seeder site and some of the other initiatives that you're doing, but talk to the audience what gets you excited in the industry that you're trying to play.
Well, yeah, actually, I'm at a point in my life, so I'm almost 75 now. So I'm at a point in my life where I'm not thinking in terms of work so much, quite frankly. So I write a book every number of years, but I'm not so much focused on the industry. And as you mentioned, the Fund Seeder connection, but that's on an advisory capacity as needed. And other than that, I'm more interested in stuff like going kayaking or something. So that's the honest answer. I'm not so much focused on the work aspect anymore.
But presumably you still find it fun to be involved in markets, and I'm sure you've got your own thoughts, right, as far as what's happening here and now.
Oh, I always have my own thoughts, but I don't think they're worth much. No, to be honest, I mean, I always try to tell people, hey, I write about market wizards, but I'm not a market wizard, and I never pretend to be. So I hopefully am net profitable only because I have enough experience, not because I'm a good trader. But my opinion on what's likely to happen or not is, I don't think, worth more than anybody else's. And in fact, a lot of the traders I interviewed will tell you that they're not in the prediction game at all anyway. They're just trying to assess what the market's going to do here and now, and they have a plan for getting out quickly if they're wrong. And that's more important than a grand prediction.
What are, aside from sort of the successful traits, any thoughts on sort of what made some of these traders go through these periods of inevitable underperformance? Were there any common mistakes that were made during those structures?
Yeah, I mean, there is certainly a common mistake. The most common mistake among the traders I interviewed, which are some of the greatest traders, as well as most people, is the same mistake. And that's a failure of risk management or an absence of risk management in many cases. And if you read through the books, you'll see that where these traders experienced their early woes, in those cases where they did, it inevitably comes down to a grand failure of risk management. Sometimes having everything bet on one trade, things of that nature, which of course they would never do at this point in their career, but in the early days they did do. And I think amateur traders, that's the greatest danger too, is that they don't think about risk management. They have positions that are too large. They don't have a plan for what to do if they're wrong. They don't realize that the impossible often happens in markets. They say, well, the market can't go below this level. Well, sure it can. And it can go to half of that. And it can go to half of that. And these things happen. And so that is the greatest commonality and weakness in terms of failure. If you look on the most failures, somewhere the explanation will come down to a failure of risk management in one way or another.
Although in fairness, and as frustrating as it's been, it's just been fact. I mean, that risk management, you can argue, has been outsourced to the Fed, right? I mean, that was the whole buy the dip, idea for a long time. Now you can argue that that's not there anymore. We'll see. But presumably risk management when you're dealing with averages matters less than when dealing with individual stocks.
Well, I think risk management works on two levels. I mean, it works on individual positions and it works on your portfolio as a whole. So those are two levels of it, both of which are important. So you can address risk management. I mean, presumably you can address risk management on a position by position, but still fail on a portfolio level. If, let's say, your positions are super correlators, thing like that. I guess if you deal with it at a portfolio level, there's a limit how much you can do. So, but to really deal with it on a portfolio level, you do also have to go to a position level. I don't know if that answers the question.
What I'm really going with that is that, look, the ultimate risk is risk of ruin, which is basically a company going bankrupt and the equity going to zero. Like it's
on any individual. Right. So anything can happen in an individual position, which comes down to one piece of advice you'll see repeated multiple times throughout the books is this idea of limiting the risk on any single position, because you don't know. You just don't know what can happen. And crazy things can happen that are just unpredictable and they may not be your fault, So the trade may make all the sense and you may have made all the right decisions, but something out of the blue happens that just, wipes out that trade. And it's nothing you could have foreseen. And you may even have had a stop, and maybe the market, because this happens, the market opens way beyond the stop. So that's why you don't want to have any position too large and any single position too large. And also, of course, you want to have a theoretical point at which you'll be out of that position.
I wonder if you think in 10 years, 20 years, there's going to be a whole new group of market wizards that have nothing to do with stocks and have everything to do with crypto. If that's sort of a play that's coming.
You're presuming there'll be a crypto market in 20 years.
That is true, right? That's correct. Right.
There may be a few cryptocurrencies, but I personally, I doubt that a lot, there's of all these multitude of cryptocurrencies out there, I'd be surprised if more than a handful are long-term survivors. And I don't know what the prospect is, for the handful, but I don't think crypto is going to be an important. I could be dead wrong. I just don't see it as being an important area, 10, 20 years out. It might be an area, but in scope of the world finances and world assets, I think it'll be a teeny proportion. I don't see it being a big proportion.
Of the various traders that you've interviewed over the years, have you kept in touch with a lot of them? Have you developed good friendships with them?
No, I actually haven't. In most cases, in almost all cases, it's a matter of just doing the interview, spending time with them, and in most cases that's it. I don't have future contact. In some cases, There may be a contact again in the future for one reason or another, but it's sporadic. And there are no, like Michael Marcus. I actually haven't been in touch with Michael Marcus for over a dozen years. So, but he's somebody I knew from the beginning. But he was not a close friend, but he was at least a friend. But when he moved on, we didn't see much of each other. Peter Brandt, who's in the most recent book, is that we don't live near each other, so we don't see each other very often. But he is a friend. He is a close friend. Those are the exceptions. In virtually every case, it's somebody that I just met and spent time with for the sake of the interviews, and that was it.
Were any of those that were interviewed unhappy with the interviews, or kind of pushed back on some things that were transcribed?
Well, actually, surprisingly, well, maybe not surprising. No, the answer is no. I mean, I'm not aware in all the interviews I did and all the books I did, I'm not aware of any trader that was dissatisfied with the outcome. Actually, there's a thing that prevents it from even getting published if that's the case, because one of the things I have done all along is, and let me explain why I do this. I want people to be as honest as they can be, and so I tell everybody, before an interview that you'll get a chance to review the interview before it's published. I do that for several reasons. I do that, well, first of all, just to double check my accuracy, okay? But also I do it so they know that they won't be blindsided, and then they can talk more openly. Because otherwise, if the interview is done and that's the last I'll know of it, then they're censoring themselves constantly. But this way, I assure them, look, I'm not going to print unless I have your approval. Now, there's been a few cases where I didn't get the approval. So that can happen. And there may be different reasons for that. In the cases that it did happen, it didn't happen often. It didn't have to do with that they didn't like the interview. There were other reasons. But it happens only a few times. And other than that, everybody else had a chance. Oh yeah. Then they may have say, well, no, they may on some sort of thing say, well, this is not what I meant this or whatever. And we agree on some sort of, word change that we're both satisfied with. But those in most cases, those type of edits are minimal or non-existent. And when they are, we just discuss it to reach a point of mutual agreement. So I haven't had the experience of anybody actually being displeased with the interview.
A question from a Twitter thread here saying, what was a trader with the lowest turnover? Turnover is an interesting one to think through in the sense of, is there any kind of link between, high turnover and higher performance, or lower turnover and higher performance? Any sort of interesting insights there?
So turnover meaning, of course, how frequently you're trading.
Right.
And so I don't have the full statistics to answer it, but if I had to place a bet, I would say it would be probably somebody like Jim Rogers, who tends to hold positions for a very long time, or tends to think in multiple years on positions. So I think he'd be the type of person who would turn over infrequently in terms of major position holdings. That's the one that comes off the top of my head as most likely to have low turnover.
But you say for the most part that you need some degree of activity. I mean, presumably the greats are also very good at changing their mind quickly enough.
Yeah, well, that's another. I mean, changing your mind quickly enough is critical. And a lot of traders do that, and instantaneously can change their position totally, on a dime. Yeah, I mean, not just get out because they think they're wrong, but reverse the position at the same time. And I can give you examples of that, but that's actually a trait of a great trader.
Right. Although that is very hard to find on social media platforms, right? Because I've experienced this myself, right? People say, well, you're flip-flopping. And it's like, well, no, that's what you're supposed to do.
Yeah, then that kills me. People accuse, usually politicians get accused of flip-flopping, but which is a crazy thing because, you have to be an idiot not to flip-flop, when you should. So, I mean, the famous phrase, the saying that's attributed to Keynes, I don't actually know if he ever said it, but to paraphrase it is, yeah, when the facts change, I change my mind. What do you do, sir? What do you do, sir? So, I mean that whether he said it or not, that phrase that's attributed to him is actually a great way of putting it. if the facts change, you got to be an idiot not to change your mind. So this criticism always strikes me as really dumb. A person of course, it's the reason for the flip flop. If you're changing because you recognize you've been wrong, that's what a strong character should do. If you're flip flopping to please because you think you're trying to get elected, you think that the electorate wants the opposite of what you were saying, and you flip flop because of that, even though you still believe in what was true. Well, that's where it's a valid criticism, but that's not the way it's usually applied.
The other thing that drives me crazy is, and I'm sure you must have seen a lot of this, is people always want to trade like this person or that person, trade like Buffett, trade like Thorpe, trade like whatever. And I always have a problem with that intellectually, because it's like you can never trade like somebody, even if you knew exactly what they knew. Your emotional response to markets is unique to you, right? And will cause you to trade in different ways. Where I'm going with that is it possible to really mimic and trade like the greats, like the Druckenmillers of the world, or is there something that's just some sort of physiological and unique to them?
No, I mean, I think you can learn from all different people, and you can pick up elements of different people's style, and your style may be similar to them, but it's always by definition going to be different. And it's not, I think it's a mistaken quest to try to copy somebody else's style, because what may work for one person, if another person tries to copy it, it's not going to work for them, because they're just not going to have the same reaction to markets. And just like people are different, the approaches that would work for people have to be different. It can't be exactly the same. You're not exactly the same as the person you're trying to copy.
I think that's a good place to wrap this Twitter space up. Jack, how do people find you aside from here on Twitter?
Just on Twitter, obviously, and I have a website that I have to admit I don't really do much, but there's stuff on it. At jackschwager.com, and at Funseater. Well, I'm not. There's nothing to post there, but if people are interested in getting analytics on their performance, they can check that out.
Very good, Jack. I appreciate your time here. Thank everybody for joining. Thanks, Jack. Appreciate it.